want to give a quick shout to Seb Joseph, who asked in the comments if I had any videos on estate tax or gift tax, and I don't think I had any where I went into it. So thank you for asking, and I'm happy to do more request videos. If anybody has anything that they want to learn more about, I could probably tell you more than you wanted to know. Welcome to the Buck Talk Fireside. Today I'm going to tell you much more than you've ever wanted to know about gift tax, estate tax, inheritance tax, and if you don't have a drink, go ahead and get one now. Also, if you haven't subscribed, and let's be real, you probably haven't, hit that subscribe button, give me a like, let's get on with it. Okay, so gift tax, estate tax, inheritance tax, they're all talking about the same thing. So it's a gift when you're alive, it comes from an estate if the person has died, and inheritance really is the same thing as estate, just coming from the point of view of the inheritor. The U.S., and I'm going to be talking federally here, some states have different rules, but not very many. Most states don't have any gift tax, estate tax, or inheritance tax. But federally, in the United States, there is no inheritance tax. So you will never owe tax because you have received anything either via a gift or via someone's estate. The tax always needs to be paid by the person making the gift or by the estate that's leaving you money. So if you got a big check because somebody passed away, you don't have to worry about tax bill coming for you. A lot of people have heard of the fact that you can give $15,000 before any gift tax kicks in. And that's correct. That's correct. But it's a small bit. And it's actually what's called the annual exclusion. So you can gift 15,000 people to as many people as you want in one calendar year, and you don't have to report it. There's going to be zero gift tax owed. So I could gift $15,000, if I had it, to every single person that I passed on the street. And I don't have to report it. Nobody's got to pay any taxes. It's below the threshold where that's got to be reported. If you gift more than that to a single person, let's say I gift $15,010 to my brother. Well, the first 15 got that exclusion. The next 10, I've actually got to report that. And you might say, well, Jack, don't you have to pay tax on it? And the answer is no. So in addition to your annual exclusion, you've also got what's called a lifetime exemption. And I'll back up a little bit. The reason we're talking about estate tax and gift tax here is if you do have to pay it, it's 40%. That's 40. So it's a pretty hefty little bit of tax there. It's pretty serious. Back to our $15,010 gift. I've got to tell the IRS, hey, I gifted $15,010 to my brother. The $15,000 was my annual exemption, my annual exclusion, and $10 is going to go against my lifetime exemption, and it's going to reduce it. You naturally say, well, Jack, how big is your lifetime exemption? Right now, it's $11.7 million. So what does that mean? Anybody can leave anybody else 11.7, and this is combined actually. So it's not like the going around on the street example. This is combined. Can leave the rest of whoever's in their will, in their trust, $11.7 million before you have to pay any estate or inheritance taxes. Now, I'm recording this video right at the end of 2020, beginning of 2021, and we'll see if that changes. 11.7 is the number for 2021. It's actually going to go back down to a number that's about half that at the end of 2025, unless Congress does something different in the meantime. But that means you can die, and if you leave less than $11.7 million, nobody is going to be paying any gift or estate tax unless you've used up some of your exclusion during your lifetime. So in my example, that $10, that gets weighed against the 11.7, and you actually have to file a document with your tax return that keeps track of it and says Jack doesn't have $11,700,000 of exclusion anymore, or of exemption anymore. He's got $11,699,990 left over. If you're married, you can double all of those things. So back to our $15,000 a year, let's say parents are trying to gift to their kid. Well, each of them can actually gift $15,000 a year using that exclusion. So they could gift 30. And if that kid is married, actually they could do 60, because remember, you can do 15 to each and every person you want. So you can actually multiply this and start to move a lot of money and not pay any gift or estate tax by using just annual gifting, using those annual exclusions. I will get a little nerdy with you here. So if you do the math, it is actually better to gift during your lifetime, if you're trying to reduce how much you pay in gift or estate tax, than it is to leave money to somebody at the end of a lifetime. So the reason is, if you have, well, let's pretend that the person in this case, they used up their entire exemption. They gave $11,715,000 to somebody last year, or January 1st, 2021. And therefore, they used up their entire exemption, but they got a little money left. They got $10 million left, and they want to give it to you. And they can either give it to you right away, or they can leave it to you when they die. If they leave it to you when they die, and let's say for the sake of example here, they're just going to leave you all $10 million of it. The IRS is going to say $10 million times 0.4, and we're going to take that. We're going to take that $400,000. The math is a little different, actually, if you're trying to gift it. And I'll prove this in a spreadsheet. Hold on. And by the way, I realized just a second ago I said $400,000. We're talking $10 million, so 40% of that's going to be $4 million. So, and this is going to be really important and a little tricky, so pay close attention here. Something gets left in an estate, let's say it's $10 million. There's going to be a 40% tax. That's going to leave you with $6 million. The math is different because the order is different when there's a gift. So when there's a gift, we can actually gift, if we've got $10 million, 7.142857, and then a whole bunch of pennies of dollars, because 40% of that is only 2.8 million. We still used the same 10. So because of the order in which it happens, it is actually significantly better to make a gift while you're alive than to leave something in an estate. So it's an important estate tax planning issue. It's not important for very many people right now with the exclusion being so big, with your lifetime exemption being so big. But if that does come back down, and there have been proposals floated over the years to bring it back down to where it used to be at about $1 million, then it's going to be really important to a lot of people. So I brought you back, and now you know there's probably not going to be any gift or estate tax issues that you need to know about. Even if you or somebody else was gifting a huge amount in 1 year, $100,000, $1 million, it is more than that 15,000. But if you still got your lifetime exemption, there's not going to be any tax due. It's just going to eat into what you can have for that. Yeah, you or your CPA's got to remember to file it, but it's very unlikely, unless we're talking huge numbers, that anything's going to be owed. The next question, and I'll just give the really short version here, and maybe I'll do a whole video on it later, is, hey, what if the value of that thing, whether it's a house, a piece of real estate, or stocks, what if the value of those went up and you have inherited them and then you sell them Do you owe tax on that? And the answer is generally no. So for most assets, when somebody owns it and dies, you get what's called a step up in cost basis. This does not happen for a gift. So if you are gifted something, usually the cost basis transfers. And cost basis just means what's been paid for it originally. And then if it's real estate, you got to subtract whatever depreciation's been taken. But let's say you had a stock that was $100 and it went up to $1,000. Your cost basis is $100. If it was gifted to you and then you sold it for $1,000, you would probably owe capital gains taxes on that $900 difference. If you inherited it, usually what happens for almost all assets is that the cost basis goes from what it was when the person bought it to the value on the date of their death. There's some other complicated rules that work with that, but in general, that's the way it works. This does not apply to quite everything. So if somebody owns an annuity, there's actually no way to get rid of the gain in an annuity. You cannot die to outrun it. And IRA type accounts, so traditional IRAs or 401ks, those taxes haven't yet been paid on them. They were never taxed as earned income. They do not get any kind of step up in cost basis. You do have to pay tax when you withdraw from your probably inherited IRA. Good luck. Happy hunting. Hopefully you know a little bit more about gift and estate tax.